Mortgages always kind of fascinated me.
Oh, yeah.
Yeah, I mean, they're such a big part of how our economy works, but most of us only really think about them when we're trying to buy a house.
True. It's easy to get bogged down in all those forms and legal terms when you're right in the middle of it.
Definitely.
But there's a really cool story behind mortgages that goes way deeper than just interest rates and closing costs.
For sure. And that's what we're going to explore today in this deep dive into a YouTube video called ¿Qué es una hipoteca in 2024? Edgen Hipotecas 2024.
Lo que debes saber.
Catchy title. I know, right? It's from the channel Riqueza Vital. Now, the video's in Spanish, so we've translated the key takeaways for everyone listening.
Riqueza Vital focuses on personal finance, and what's really interesting about their take on mortgages is how they link the history of these financial tools to how they impact society today.
Exactly. That's what I love about these deep dives, uncovering those unexpected connections. So let's rewind the clock. Where did mortgages even come from in the first place?
Believe it or not, the idea of a mortgage goes all the way back to ancient Greece.
Really?
The word itself comes from hypo, meaning under, and teca, meaning box.
Under the box.
Yeah. Seems like they were already trying to hide fees way back then.
Those sneaky Greeks. But seriously, what do they mean by a hidden agreement?
Back then, a mortgage was like this secret deal where someone in debt would pledge their property as security for a loan. So it was literally kept under wraps.
Huh. Interesting. So if the debtor couldn't pay back, the creditor could just take the property.
You got it. The idea evolved under Roman law, becoming more official and starting to look more like the modern mortgage we see today.
So how did we get from these hush-hush agreements to the complex system we have now?
This is where it gets really cool. The creation of mortgage registries changed the game.
Mortgage registry.
Yeah. This made a public record of mortgages, making everything much more transparent and secure.
No more secret deals. So it's good for borrowers, right?
It was definitely a step toward more transparency. These registries helped protect both borrowers and lenders by setting clear legal rules for these transactions.
And speaking of rules, I think it's time we define what exactly a mortgage is in today's world. The video we're looking at gives a pretty simple definition.
They describe a mortgage as a legal agreement where a property is used as collateral for a loan. The lender has the right to sell the property if the borrower doesn't repay the loan as agreed.
Right. Makes sense. But that analogy they use in the video comparing a mortgage to pawning your house feels a little misleading. It's not like the lender actually wants to take your house, right?
You're right. The lender's main goal is to get their money back, not become a homeowner.
Of course.
Think of it more like a small business getting a loan and using their building as collateral. If they can't pay back, the bank can take the building to cover their losses.
Okay, that makes more sense. So the property is like a safety net for the lender.
Exactly. And this leads to a key point. The video stresses the two sides of a mortgage.
Two sides.
It's both a contract and a real, right?
Oh, right. I remember trying to wrap my head around that concept back in my finance class. Can you break that down for us?
Of course. As a contract, a mortgage lays out the terms of the loan, how much is borrowed, the interest rate, how long you have to pay it back, and all those details.
Okay, that's the paperwork side of things.
Yeah.
But what's this real right business?
It means the lender has a direct claim on the actual property itself. It's not just a promise to repay. It's a legal right tied to the house or land.
Ah, got it. So that's how they can legally sell the property if you can't keep up with payments. It's not just a threat. It's part of the deal.
Precisely. And this dual nature is really important for understanding how mortgages work. It balances the borrower's right to use the property with the lender's right to have that security.
So it's this delicate dance between rights and responsibilities.
Yeah.
Speaking of responsibilities, let's talk about the different types of mortgages. The video mentions two main ones, voluntary and necessary mortgages.
Exactly. Voluntary mortgages are those the borrower chooses freely, like when someone wants to buy a home or get funding for a business, and they use the property as collateral.
So the typical home loan most people get would fall under this category.
Yep. Now, necessary mortgages are a bit different. These are imposed by law, often to secure debts that aren't your usual loans.
Interesting. Can you give us an example?
Sure. If you owe back taxes, the government could put a necessary mortgage on your property to make sure they get paid. You don't really get a say in that.
Whoa, that sounds intense.
It can be.
So it's important to know the difference because the consequences can be pretty different too.
Absolutely. The circumstances surrounding each type of mortgage are really important for understanding the rights and obligations of both the borrower and the lender.
Okay, so we've got the history, the definition, and the types. Now, let's get into the nitty-gritty of how a mortgage actually works.
Yeah.
The video breaks it down into 4 key stages, starting with constitution.
Right. Constitution is all about creating that mortgage contract, which is usually a public deed signed in front of a notary and registered to make it legally binding. It's a formal process that makes the agreement between the borrower and the lender official.
Sounds like a lot of paperwork.
It is, but that's because it's a serious legal agreement with big financial consequences.
I get it.
Next comes the obligation, which is the borrower's promise to pay back the loan according to what's outlined in the contract.
Right, you got to keep your end of the bargain part.
Yeah.
What about the creditor's rights? We touched on this earlier, but what exactly can the lender do if the borrower just doesn't pay?
Well, if the borrower doesn't meet their payment obligations, the lender can start what's called foreclosure proceedings.
Foreclosure.
This could involve a judicial sale or auction to sell the property and get their investment back.
That's the scary part that makes mortgages so stressful. But what about the borrower's side of things? What rights do they have in this whole arrangement?
The borrower isn't completely powerless. They still get to possess and use the property as long as they're following the rules of the mortgage.
So they can live in the house, rent it out, even renovate, as long as those payments are made on time.
Exactly. However, it's important to remember that the property technically still acts as collateral.
Right. It's that balancing act we were talking about between the borrower's use and the lender's security.
Yep.
Speaking of balancing acts, the video makes an interesting point about the mortgage and the loan being separate things. Can you explain that a bit more?
Absolutely. The loan is the actual debt, the money that's borrowed. The mortgage is the thing that backs up that debt.
Okay.
They're two sides of the same coin, legally speaking.
That's a subtle but important difference. It's not just semantics.
Yeah.
It has real legal implication.
You got it. Understanding this separation can help you navigate the complexities of mortgages more effectively.
Okay, so we've laid some groundwork. We've gone from ancient Greece to modern mortgage contracts, explored the different types, and dug into how they work. Are you ready to tackle the pros and cons?
I think our listeners are definitely ready to hear about the pros and cons.
Let's start with the good stuff. The advantages. Mortgages have helped so many people become homeowners who wouldn't have been able to afford it otherwise, right?
That's the biggest advantage. Instead of needing hundreds of thousands of dollars up front, a mortgage lets you spread the cost over decades.
It's easy to forget how big of a change that is from how things used to be.
For sure. And on top of that, mortgages often come with better interest rates and more flexible repayment terms compared to other loans, all because the property is there as security.
So there's some definite perks to using a mortgage, but I'm guessing those perks come with some strings attached. What about the disadvantages? What should potential borrowers watch out for?
Well, the biggest risk is foreclosure. If you fall behind on your payments, you could lose your home. It's a harsh reality, but one that every potential borrower needs to think about seriously.
It's the kind of thing that keeps people up at night. And it's not just the monthly payments you have to worry about, right?
Exactly. There are other costs involved. Things like notary fees, registration fees, insurance, bank fees, they all add up.
Yeah, those closing costs can really catch you off guard.
They can. And even if you can handle the monthly payments, a mortgage is a long-term financial commitment that can impact other choices you make in life.
How so?
It can affect how much you're able to save, invest, or even take that dream vacation.
Makes sense.
It's a major decision that needs careful planning and thought.
So it's not just about the house itself. It's about how it fits into your overall financial well-being.
You got it. It's essential to weigh the potential risks and rewards before taking on such a big financial responsibility.
Now that we've got the advantages and disadvantages down, let's switch gears and talk about how mortgages have shaped societies as a whole.
Okay.
We often think of mortgages as individual financial tools, but they've played a huge role in shaping economies and even how our communities are structured.
They have.
I'm intrigued. Tell me more about this bigger picture impact.
Well, think about it. The widespread homeownership we see today wouldn't exist without mortgages. They've allowed millions of people to buy homes who couldn't have dreamed of it before.
That's true. It's easy to take that for granted, but it's a massive change from how things used to be.
Definitely. And this change has had a ripple effect on everything from how cities grow to social mobility.
So mortgages are like this hidden force shaping the world around us.
In a way, yes. They're a key driver of economic activity, influencing things like construction, real estate markets, and even how much people spend.
Wow, I never thought of it that way. But it makes sense when you connect those dots. It's not just about economics either. Homeownership is often seen as this cornerstone of stability, contributing to stronger communities and a sense of belonging.
You're absolutely right. And while that dream isn't always easy to achieve and isn't attainable for everyone, mortgages have definitely played a big part in shaping that aspiration.
It's amazing how something as seemingly dry as a financial tool can have such profound social and cultural effects.
It really is. And it just goes to show how important it is to understand these systems, not just for our personal finances, but for how they impact society as a whole.
Well, I think we've covered a ton of ground in this first part of our deep dive. We've explored the history of mortgages, defined what they are, and even touched on their wider impact on society. But there's still much more to uncover.
Definitely, there is.
Stay tuned for the next part of our deep dives, where we'll take a closer look at what it takes to apply for a mortgage, what lenders are looking for, and the key things you should keep in mind before diving in.
It'll be good.
It will.
Welcome back to our deep dive into mortgages. Last time, we went all the way back to ancient Greece, tracing how mortgages evolved and what kind of impact they've had on society as a whole.
It's wild how something so, technical can have such a big impact on culture and how people live.
It is. Now, for anyone out there thinking about buying a home, let's break down how to actually apply for a mortgage and make it less mysterious.
Yes. Let's open up that black box. What are the main steps involved?
First up is the financial evaluation. Lenders want to see how healthy your finances are to figure out if you can actually handle the loan. They'll look at your income, any debts you have, your assets, and your credit history.
So it's like a background check, but for your money.
Exactly. They want to see proof that you're responsible with your finances. A steady income, debts you can manage, and a good credit score. Those are all green flags.
What about that debt-to-income ratio thing I keep hearing about? How important is that?
Oh, that's a big one. The debt-to-income ratio, or DTI, shows how much of your monthly income goes toward paying off debts. Lenders like to see a lower DTI, usually under 36%. It tells them you have enough wiggle room to handle those mortgage payments.
So it's not just about how much you make, it's about how much of that money is already going out the door to other debts.
Right.
That makes sense. What happens after they check out your finances?
Then comes the property appraisal. This is where a professional appraiser comes in and figures out what the property you're looking to buy is actually worth on the market.
So the lender wants to make sure the house is worth the price tag, right?
You got it. The loan amount is usually based on a percentage of that appraised value. They don't want to lend more than the property is worth, especially with that risk of foreclosure looming.
Makes sense. Got to protect their investment. Okay, so you've passed the financial check, the property's been appraised. What's next?
If everything checks out, you move on to credit approval. This is where the lender officially says yes to the loan, and you'll start working out the details.
Okay, so this is where it gets real. What kind of details are we talking about here?
This is where you and the lender figure out the terms of the mortgage. Things like the interest rate, how long you have to pay it back, and what type of mortgage it is. It's super important to understand the different kinds of interest rates, fixed and variable, because they can really change how much you pay each month and the total cost of the loan.
Can you break down the difference between those interest rate types?
Sure. With a fixed-rate mortgage, the interest rate stays the same throughout the entire loan. That gives you some predictability and stability. A variable rate mortgage, though, has an interest rate that can go up or down, depending on what's happening in the market.
So with a variable rate, you're kind of rolling the dice.
In a way, while variable rates can look good when they're low, there's always the chance they could jump up in the future and you'll end up paying more each month.
It's like a trade-off between saving some money and taking a risk.
Yeah.
Definitely something borrowers need to think about carefully. What about the loan term? How does that play into all this?
The loan term, or how long you have to pay back the mortgage, that also affects your monthly payments and the total interest you'll pay. A shorter term, like 15 years, usually means higher monthly payments but less interest overall. A longer term, like 30 years, means lower monthly payments but more interest in the end.
So it's a balancing act between what you can afford each month and what you want your long-term finances to look like.
Right. It all comes down to each person's situation and what's important to them. Okay, so we've got the interest rate and the loan term figured out. Now what?
What happens next?
Time for the contract signing. This is the official moment that makes the agreement legally binding.
I bet this is where those notorious closing costs show up, huh?
Closing costs are those extra expenses you have to pay on top of the loan itself. Things like appraisal fees, title insurance, fees for recording the mortgage with the government. They can add up to a pretty big chunk of change, so it's best to budget for them right from the start.
It's like the hidden cost of buying a home.
You could say that. But knowing about these costs ahead of time can help you avoid any nasty surprises later down the line.
Okay, contract signed, closing costs paid. What's the final step in this whole mortgage marathon?
Last but not least, we need to register the mortgage. This is what makes it official and enforceable. It creates a public record of the mortgage, which protects both the borrower and the lender.
So it's a long process with a lot of steps, but each one has a purpose in keeping everything above board and protecting everyone involved. It's all about creating a system that's transparent and legally sound for this whole complicated financial transaction.
Exactly. Now, even though we've covered the main steps, there are a few more things potential borrowers should keep in mind. Things like your credit history, that debt-to-income ratio we talked about, how much you put down as a down payment, those interest rates and loan terms, and of course, those closing costs. All of these can affect the mortgage process and what kind of deal you get.
We've touched on some of these already, but let's dive a bit deeper into each one, starting with credit history. I know having a good credit score is important for getting a good loan, but how does that actually work?
Your credit history is basically a report card of how you handle borrowing and paying back money. Lenders use this to see how likely you are to pay back the loan. A higher credit score means you've been responsible with borrowing in the past, so lenders see you as less risky.
So those late credit card payments can come back to bite you.
They can. It's so important to build good credit habits early on and keep them up. That means paying bills when they're due, keeping your credit card balances low, and not taking on more debt than you need.
Sounds like good financial hygiene is key. What about the down payment? How does that affect things?
The down payment is the money you pay up front toward the purchase price. The bigger your down payment, the smaller your loan will be, which means lower monthly payments and less interest you'll pay over time.
So saving up for a good chunk of money for a down payment can really pay off down the road.
Absolutely. It also shows the lender that you're serious about buying the property and have some skin in the game. But I know saving up for a big down payment can be a huge challenge for a lot of people, especially with how expensive houses are these days.
For sure. It's tough. You need a big down payment to get a mortgage, but it's hard to save that much without the stability that comes with owning a home.
You're telling me. And this can create a real disadvantage, making it harder for people with lower incomes to buy a home and build wealth through homeownership.
Are there any programs or options out there for people who might struggle to save up a big down payment?
There are. Some government-backed loan programs, like FHA loans, don't require as much money down. This makes it easier for certain borrowers to become homeowners. It's always worth looking into these programs and talking to different lenders to see what you might qualify for.
That's really good to know. Now, let's go back to those interest rates for a minute. We've talked about the difference between fixed and variable, but what are some of the things that can change the interest rate a borrower is offered?
A bunch of things play a role, including your credit score, the type of mortgage, how long the loan term is, and what's happening in the market in general. Usually, people with higher credit scores and shorter loan terms get offered lower interest rates because they're seen as less risky to the lender.
So it's smart to shop around and compare offers from different lenders.
Definitely. Don't just go with the first offer you get. Take some time to research different lenders, see what their rates and terms are, and try to negotiate for the best deal you can get.
It's all about being informed and being proactive as a borrower. Now, before we get to the final part of our deep dive, let's revisit that idea of how mortgages affect society as a whole. You mentioned earlier that the fact that more people can own homes because of mortgages has changed how cities develop and even social mobility. Can you tell us more about that?
Sure, having mortgages available has really fueled the growth of suburbs. More people have been able to afford homes outside of packed city centers, which has changed transportation patterns, how infrastructure is built, and even how people interact with each other.
That's an interesting point. I hadn't thought about how it affects all those other areas.
It's all connected, and the impact mortgages have on society keeps changing as economic conditions, housing policies, and demographics shift.
It really shows that these financial tools aren't just abstract ideas. They have real-world consequences that shape the communities we live in.
Absolutely. And as we keep exploring the world of mortgages, it's important to think not just about how they affect individuals financially, but also how they affect society as a whole.
Well said. Now, for everyone who's stuck with us on this mortgage journey, stay tuned for the final part of our deep dive. We'll be tackling some big questions about the future of mortgages and what role they'll play in making housing more fair and accessible for everyone. And we're back for the final part of our deep dive on mortgages. We've gone from ancient Greece to modern-day applications and even talked about how mortgages affect society at large.
It's been a journey. As we wrap up, I want to leave you with some things to think about, some questions that go beyond the nuts and bolts of mortgages and look at how they fit into a fair and equitable society.
I like where this is going. It's fascinating to connect these financial things to bigger social issues.
Right. So while mortgages have definitely made it possible for more people to own homes, they've also played a part in keeping economic inequalities going.
That's something people don't always think about when they're excited about buying a house.
Yeah.
How have mortgages contributed to those inequalities?
Well, first off, not everyone has equal access to mortgages. Historically, things like redlining have made it harder for certain groups, especially people of color, to get mortgages or get good terms.
Right.
And that's had a lasting impact on how much wealth people can build and how many people own homes. It's contributed to the racial wealth gap we see today.
It's a reminder that financial systems aren't neutral. They can actually reflect and even make existing societal biases worse.
Exactly. And even setting aside discriminatory lending practices, the way the mortgage system is set up can make inequalities worse. Think about the down payment, for example. For a lot of first-time homebuyers, saving up for a big down payment is a huge obstacle.
Especially with housing costs going up.
Yeah.
It's a tough situation. You need a big down payment to get a mortgage, but it's hard to save that much without the stability of owning a home.
Exactly. It can create a cycle where it's harder for people with lower incomes to get into the housing market and build wealth through homeownership.
So it seems like we might need to rethink how we approach mortgages if we want a housing market that's fairer and more accessible for everyone.
Couldn't agree more. We need to tackle the root causes of these inequalities, promote fair lending, and come up with new solutions that make homeownership a reality for more people.
That's a powerful message. It reminds us that these financial tools have real consequences, shaping our communities and our lives.
They do. As we move forward, it's so important to keep asking questions, challenging what we think we know, and pushing for a financial system that's more just and inclusive for everyone.
Well said. On that note, we've reached the end of our deep dive into the world of mortgages.
We've traveled from ancient Greece to the ins and outs of modern finance, looking at the history, how they work, the good, the bad, and the impact they have on society as a whole.
We hope you, dear listener, now feel more equipped to navigate the world of mortgages with a deeper understanding and a critical perspective.
Remember, knowledge is power.